Hello, everybody. For those of you who don't know me, I'm Steve McGregor, Head of Advisor Support for Tavistock Wealth. Delighted to be joined today by our Chief Investment Officer, John Leaper. Hi, John. How are you?
Very good, Steve. Second video. I'm getting used to these now. Thank you.
Absolutely. Thanks very much for taking time out of your day to join us. I thought it'd be really worthwhile to go through 15-20 minute Q&A around our Acumen protection portfolios. They've got quite a lot of interest internally, increasing interest externally, and I thought it'd be helpful just to remind everybody how they work and then just have a look at how they've done this year. So I suppose just to kick off with a nice easy one, what are the protection portfolios?
Well, thanks for starting with an easier question. Well, we have 10 multi-asset class UCITS funds, and 3 of those are protection portfolios. So to keep it short, they're volatility managed, which means that the volatility stays within a certain band. They're unlikely to move too far in any particular direction. And also there's a capital guarantee, which is provided by Morgan Stanley, which means that investors will not lose in a worst case scenario more than 90% of the highest ever recorded NAV for the Acumen Capital Protection and the Acumen ESG Protection, and will not lose more than 85% of the highest ever recorded NAV for the Acumen Income Protection Portfolio. So there are 3 protection portfolios, and I suppose one nuance worth mentioning is the Acumen ESG Protection Portfolio also subscribes to our best-in-class ESG investment policy, which we're getting a lot of interest in at the moment.
Sure, thank you for that. So just to be crystal clear on that, the maximum loss for a client in those portfolios is 15% and 10% respectively.
Yes, correct.
Fantastic. So how does that work? How do the protection portfolios work in practice?
Well, there's kind of a unique structure that we built to ensure that remains the case, and also Tavistock Wealth works, in partnership in many ways with Morgan Stanley. So Morgan Stanley help provide the guarantee, whereas Tavistock Wealth manages the investment proposition, which is very much the engine that provides growth for the fund. So the starting point really is an asset portfolio, which is comprised of ETFs managed by Tavistock Wealth that provides broad multi-asset class exposure, but predominantly to both fixed income, bonds, and to equities. So that's the starting point. Then you move along to something called the volatility control mechanism. And what this does is it looks at this basket of ETFs and it looks at how it moves as the markets move. And the main role is to ensure that the volatility of this basket stays within certain parameters. If the volatility starts to rise too much, so say markets are selling off and the portfolio is moving down, or actually conversely to the upside, markets can be volatile and rise at the same time. If it moves outside the range within which it's meant to operate, it is a volatility managed fund, then effectively what it can do is it can take action and it can introduce cash. So you have the asset portfolio of ETFs, but if volatility is starting to rise and the way in which this is moving moves up and it moves too far, then it introduces cash into the mix to ensure that the broad volatility remains in the place that it's meant to be. We refer to this new combination of cash and the asset portfolio as the volatility target, because together it ensures that the volatility stays at the target level. The other key word to introduce here is the participation rate. And what that means effectively is X% of the portfolio is participating in the asset portfolio of ETFs, and the remainder is in cash. So that's step 2. And then the final step 3, is the fund. The fund that our clients invest in and our advisors may well recommend to their clients. And the final step in the process is, what is the exposure of this fund to the vol target, to the mix of cash and the asset portfolio of ETFs? And that participation rate is affected by the put, and the put is what provides the protection. So if markets go down, the put will rise in value, it inflates, it becomes an airbag, and that's effectively what ensures, in combination with the risk control mechanism, that investors won't lose more than 10 or 15% of their funds. So I think now would be a good time really to just briefly bring up, if possible by magic, one of the slides, which I think kind of just graphically demonstrates this process. It starts in the top left with the asset portfolio, and it moves down to the middle, the volatility control mechanism, introducing cash, ensuring it stays within the volatility parameters, and then moving down into the bottom right of the chart, which is the introduction of the put, the effect of the value of the put, and effectively the final NAV for the fund that investors gain exposure to.
Excellent. Thank you for that, John. That's a really clear explanation of what can often be a reasonably complex subject. So thanks for going through that. In terms of the put option, I think it's really important to highlight some of the things that advisors have talked to me about when they've been introduced to these funds, and they've said, "Well, this is like products of the past, right? They go to cash and then they stay in cash and they remain in cash for a period of time." And I think that what a lot of people are doing there is confusing the structure of some products that are out there and that have historically been out there, that have been backed by insurance contracts, by CPPI mechanisms, which will protect on the downside, but then won't give the ability to revert those positions and participate for the longer term when markets begin to stabilize and recover. So you talked about some of the unique features of the fund. I think that's one to really highlight, that by technical design, the protection portfolios can't become cash locked, and therefore we don't experience, and clients don't experience, some of those poor instances and poor outcomes that a lot of funds have given them in the past. In terms of moving on, we talk about protection, we talk about difficult times and when volatility rises during both falling and rising markets. We've seen a significant instance of that this year, of course. We saw a huge sell-off in February and March brought on by the coronavirus. So how have the protection portfolios performed this year? How have they protected clients' capital?
Yeah, so we're very pleased with how the protection portfolios have protected investors' money during the sell-off in February and March. So this will be a good time to refer to, I don't know whether you can see it on my screen, but this is the point at which that slide kind of comes up on your screen. But as you'll be able to see, in the chart, this is the ESG protection portfolio as an example. The decline in the value of the fund was particularly muted. The volatility control mechanism did a great job of moving out of the risk asset, and with the impact of the put as well, you can see that the NAV of the fund declined by a relatively modest margin, particularly in this example relative to the MSCI World Sterling Hedged. So the ESG fund invests in a mixture of equities and bonds and with an ESG tilt. But in this example, I kind of really wanted to demonstrate the severity of the sell-off in equity markets at this time. So during the initial stage, during February and March, equities were down to the tune of around 30%, whereas the protection portfolio was down by a far, far smaller amount. And this was, just to go back to the previous point, this is partly due to the protection, the mechanism, the volatility control mechanism, which is automated. It looks at volatility on a daily basis and takes steps to effectively move into cash as the portfolio is selling down. But actually, we have a process in-house at Tavistock Wealth that effectively looks at the volatility of the asset portfolio of ETFs. And if it's moving into the danger zone, I think I took the inspiration from Top Gun. Is it Highway to the Danger Zone? I can't remember what the song is. But you're in that danger zone whereby it wouldn't take much of a movement on any one given day or more to trigger a move out or the start of a larger move out of the risk asset. So, in the early days of February, we were very aware of this risk, and we actually preemptively started raising cash within the asset portfolio, which is what we have under our control, to kind of head off what we felt might be coming down the table. And the benefits of doing this are that by raising cash our end in this first step of the process, it remains under our control. We can then deploy the cash on our own choosing. Whereas if it's done at an automated level, which did happen, it's effectively subject to the way that the mechanism works. It's an automated process coming in and out.
That's really important to point out, and thank you for doing that, because a lot of the discussion around the way the volatility control works is that it's very automated. It just happens, whereas here you're indicating that we can have some involvement as to when that kicks in. We can preempt it, we can head it off before we get down to that stage. And that slide that you showed off in terms of the equity market fall versus the very shallow fall for the ESG protection portfolio is significant. And I've had lots of conversations with advisors that have put clients into the protection portfolios before the sell-off, and they've clearly got very happy clients that are able to sleep at night. So yeah, it's done its job. Since the shallow point of equity markets this year, around about the 23rd of March or thereabouts, we've seen a pretty good recovery, and we've seen a bounce, particularly in the States and some places in the Far East, where we're actually still ahead of ourselves now year to date. We've recovered all of those losses. Not quite the case in the UK. The protection portfolios haven't captured that bounce, and I just wondered if you can talk through why that's the case.
Yeah, absolutely. So just to my screen's gone off now, but to refer to the prior slide, which marketing will magically put back on your screen for you, you're right. During the initial drawdown, market sold off an awful lot more than the protection portfolios. But then from the bottom, risk assets have recovered at a far quicker and sharper rate than the protection portfolio has. Now, part of the story is how the protection portfolios were structured. So effectively, they were built from a very rigorous process of back testing markets to see volatility in markets. But actually, this has been the fastest 30% decline in certain markets that there's ever been. And when you look at the history books, everyone kind of says, well, the Great Depression. I mean, it was kind of it's faster than the Great Depression. So we really are living in remarkable times. And it does take some time using the automated volatility control process for the asset portfolio to accrete back towards fully invested. It's a very gradual process to do. So what we've done effectively is take a very innovative approach to try and resolve this. But let me just before I do that, this is a very good time to put up the final chart, which is showing the VIX, which is now my screen's back up and running. The VIX is effectively the implied volatility, in this case within equity markets over time. And in the chart that you'll be able to see from 2015 to 2019, it's moving in a range. It kind of fluctuates from around 10 at the bottom to around a number of around 25. And there are a few spikes above where you have periods like 2008, for instance, or the Eurozone slowdown, where volatility spikes. But what you'll be able to see in this chart is the significant and huge surge in volatility on the right-hand side of the chart. Now, the point is, previously where volatility has surged, it's fallen back down into the normal trend. So we're kind of going back to normal. As it currently stands, that isn't really the case. Volatility has continued to stay elevated. So compounding the backtesting story and the fact that we're seeing volatility we've never really seen before is the fact that volatility also hasn't fallen back into the range. So this means it can take a long time for the risk assets to accrete. Now, the route we've decided to go down to try and resolve this issue is work very closely with the quant team at Morgan Stanley and come up with a solution to ensure that investors can participate as much as possible in markets as we're kind of coming through this process. And what we did, and it was in many ways it was unprecedented, is come up with a process for resetting volatility. So even though the volatility spiked and the levels are quite high, which means that you have a higher allocation to cash, let's reset volatility using the same process and methodology that underlines the whole structure to a level that makes sense. And that's what we've done. So we went ahead, we reset volatility, and we brought up the participation rate. So whereas it was very low, so around the low teens at some points in terms of percentage, we brought it up to approximately 50%. So I'm very happy with that process. But at the same time, because volatility is very high, we've also kept a relatively high cash level within the asset portfolio. So these two things are almost moving in opposite directions. So why have we done that? Well, the reason we've done that really comes down to our view on the markets and our expectations looking forward. If we see a second wave of the virus, and if we continue to see rising bankruptcies and cases of insolvency, which actually we're seeing more and more every day, and if we continue to see signs that this may not be a V-shaped recovery, which is currently what is priced into many markets, then the protection portfolios are exceptionally well positioned to benefit going forward. When you look at the protection portfolios and look at the disparity in performance over the last few months, you're looking at a very short window in time. And when in actual fact, you need to take a step back and look at it over the longer run. So effectively, we're kind of a little bit cautiously positioned because we don't yet think that we're through this process, in which case the protection portfolios are really well positioned to benefit should that scenario eventuate. However, at the same time, we are sitting on some dry powder over here. So whilst in the short term, we may not have fully participated in the recovery, we do have that dry powder available. But importantly, that dry powder is sitting within the Tavistock Wealth investment team remit rather than fully within this automated risk control mechanism. So that means if we see real progress on the vaccine, which we're reading about in the press quite a lot, but in terms of bringing it to market in a timely manner, and we see signs that the recovery may pick up and bankruptcies might not be as bad as expected as we proceed. And there are some signs of this in the current earnings season, where even though the numbers are particularly bad, because a lot of the companies haven't been able to operate through lockdown, we are nonetheless seeing some earnings surprising to the upside. So doing bad, but doing better than people's worst case scenarios. In that scenario, we can deploy the dry powder and participate in an ongoing recovery. So it's a very interesting time, but I think the way that we've been managing it, and when I say that, I mean over more of a medium-term perspective rather than chasing returns over a month or two, gives us options. And that means that we should be able to deliver the best possible returns over the medium run to our investors.
I think thank you for that. I think it's also worth pointing out at our last investment committee meeting, we sat around the table and we have an economist, Sefi, comes into our meeting, and he gave his view. It's often from an economic standpoint, and it's often therefore very, very bearish. But I think Sefi was drawing on quite a lot of the research and the conversation that's taking place around the possibility of a second wave. And should a second wave come globally, at the moment it looks as if it's possibly being born out of Europe and therefore not very far away from our shores, that second wave could have a bigger impact and a far deeper impact than the first. And that is a pretty sobering thought for a lot of people at the moment that have seen the US market recover all of its losses and some over the course of the last few weeks. So I think it's very sensible not to get carried away with that and to still have that dry powder to be able to participate if we need to. But bear in mind, actually, we're not out of this global pandemic yet.
Absolutely. Yeah.
Just moving forward a little bit. So we've talked about the possibility of a second wave. We've also talked about the possibility that earnings actually are surprising on the upside. So what can we expect from the protection portfolios moving forward over the course of the next few weeks, months, years?
Well, as an investment team, we just continue to monitor the situation extremely closely. In terms of markets, the most recent developments have been the fact that the dollar has been weakening by a considerable margin. If that continues to be the case, then that in many ways is extremely good for the global economy, could be a boost for risk assets in developed market equities, emerging market equities, as well as certain commodities as well. And if that scenario eventuates, then the risk of a summer sell-off is partially reduced because it's taking some pressure off of the table in many ways. So if you think about companies and who are sitting on in emerging markets in the East, who are sitting on debt denominated in dollars, it makes a huge difference. But the dollar has come down an awful long way in a relatively short space of time. So one of the things we're looking at is, has it gone too far too quickly, and could it come back again? And if the dollar does strengthen for whatever reason, then that, in many ways, to my mind, increases the risk of a potential bout of volatility in the summer, which is usually a period where volumes and liquidity is quite low anyway, so the effects can be amplified. So the whole investment team has this laser focus on what's happening in the markets, and our view is reflected through into the protection portfolios, and it effectively comes down to the choice I was describing between currently sitting from a more cautious perspective, aware of the fact that valuations have gone very far, very quickly. As you mentioned, the S&P 500 is above where it was at the beginning of the year. And at the beginning of the year, everyone was optimistic. The economy was trundling along at a reasonable rate. And look at everything we've been through in the meantime. So how can these two things marry? So, they marry because investors are looking through the carnage to what's coming on the other end, and effectively putting full faith and confidence in the ability of governments and central banks to bridge that gap effectively. If for whatever reason that bridge collapses, the protection portfolios are extremely well positioned, and that's how we are positioned. But if things change, we will be deploying some of that dry cash to ensure that investors are participating in more of the recovery. But also, I think this kind of leads nicely on to, I think, to the final point I really want to make, which is, who are the protection portfolios for? Are they for someone who is higher risk and is kind of happy to ride the sell-offs and then the recoveries? It's probably not the case. The protection portfolios, in many ways, are better suited to the type of investor who, well, perhaps to a lifestyling strategy, where you have an investor for whom it's very important to protect those gains that they have made over the years in terms of going to work, saving their earnings, but also the returns that they've generated in the markets. Don't want to put that capital at risk as they're approaching or are already in retirement. So the protection portfolios, over a medium-term perspective, are able to lock in those hard-earned gains and savings, but at the same time, they do give a real opportunity to participate in markets and continue to generate returns over time. And I think in many ways that's how that's the kind of conversation I'm having with advisors. This, to me, this makes sense. What makes sense to you? How are you positioning the protection portfolios for your individual clients? And they're the kind of conversations I enjoy having, either with Steve or through Steve, if anyone wants to have a chat with me. Of course, Steve is in many ways the first point of call. But I want to make it clear that I'm available for those conversations, at any time.
That's really helpful, John. Thank you. I think the key point that you've hit the nail on the head there. It's what are we comparing these protection portfolios to? And we just need to be mindful of how they're constructed, how they're different from the unprotected Acumen portfolio range, and what at the end of the day the end client is looking to get from them. And it's certainly peace of mind. It's certainly capital preservation, with hopefully over the long term, not through that short window, that short lens that you were talking about, long-term growth that keeps them over and above inflation over that period of time. So as always, John, really, really helpful. Thank you. We will get this video out ASAP, and I look forward to the next one. Thanks for your time, John. Appreciate it.
Me too. Thanks, Steve.